Hi, and thanks for tuning into Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm speaking with Dan Petersen, Equities Product Manager with IndexIQ, the issuer of HFXI, a new currency-hedged ETF. Dan, welcome to the show.
Thanks, Sumit, for having me on.
Dan, for the people watching who aren't familiar with the term, what is currency hedging?
Currency hedging is something that became available probably about 10 years ago in large format, right? So in the past, it was a little bit more difficult to access compared to a liquid form in ETFs and other vehicles out there now. But it's very simply just addressing the fact that when you invest internationally, you convert your US dollars to foreign currency in order to purchase securities in those foreign markets. So if I'm buying a British company, I would have to convert my US dollars to pounds, and then in the stock exchange overseas, be able to purchase those equities domestically, or I should say locally, on those exchanges. Now, the issue with that is that if the pound were to weaken, let's say by 5% relative to the US dollar, while the British company goes up 5%, you net out a 0% return. So it directly impacts the returns of international investments.
Interesting. So in the case of the example you just gave, would you be shorting the pound to offset that currency exposure that you have from buying British stocks?
Exactly right. So if the foreign currency appreciates in value relative to the US dollar, that adds to returns. So you're exactly right that by shorting the currency overseas, you're being able to net zero the exposure. You're being able to try to isolate what happens to those equities by itself, rather than have to worry about if the currency goes up or down.
And are there any costs associated with currency hedging, Dan? How do interest rates play into this?
That's where things get a little interesting. So traditionally, people think of cost as commissions or other forms of actual direct payment. But what happens when you hedge currencies is you typically do it with what's called a forward contract, and forward contracts are priced based on sovereign rates. So the expectation is that if a rate is higher in one country than the other, then that would actually impact the currency relative valuations between those two countries. In that sense, being that the US rates are higher, the Federal Reserve rates are higher than most of the overseas rates are currently. And even looking back, that's been the case, right? If you remember, the euro actually saw negative interest rates, the yen saw negative interest rates a few years back while the Fed was near zero. So even at zero, the US had higher rates than many of the developed nations out there. But as long as the US rates are higher than the rates overseas, it's actually a negative cost if currencies don't go anywhere. So if you have a net zero currency return over the course of the month, you can actually have a what I would call a negative cost. You actually benefit from that and are able to profit off of basically no currency movement whatsoever.
Super interesting. So, Dan, I know that you're a proponent of a 50% hedged approach. Why does that approach make the most sense?
A 50% approach for us is a very natural, passive way to provide more of an asset allocation exposure to international investing, because currencies go up, currencies come down. There's really no thesis for a long-term perpetual return out of currencies as you would have for a stock or a security return, right? You expect a company to grow in perpetuity, to be able to benefit off of inflationary pressures and things like that. Currencies strengthen, but they also weaken over time. You tend to not see any one country be ultra expensive relative to another country in terms of their goods and services, their prices. So for that reason, any currency strength should almost be anticipated to be followed by weakness at some point. The problem is, how far are you looking? Are you looking 10 years, 5 years, even 3 months? Volatility with currencies can get very tricky. And over those timeframes, short, medium, or long term, very difficult to try to have a view on where currencies are going. Most indices accept currency movements for what they are. So if you look at any international index out there, MSCI indices, FTSE indices, all of these indexes that look at foreign performance at an index level assume currency as an exposure. So if the US dollar weakens, those indices are going to perform better than if the US dollar were to strengthen. So unfortunately, most people compare investments to benchmarks. And for that reason, if you completely take currencies out of the equation and foreign currencies strengthen, you're going to look like you underperform, right? So sometimes you want the currency exposure. But when you look at a year like 2022, where international investing could have been a great diversifier to a portfolio, currencies, because of the US dollar strength due to flight to quality trades that tend to happen, in times of stress. Um, Foreign currencies were down on a net basis, broadly speaking, about 7%. So your negative 7% return of local equities overseas would have been a great diversifier to negative 15, 16% on the S&P in 2022. But because of that currency movement, you are actually down pretty much as the S&P 500 with an international index level exposure. So sometimes you want the currency risk, sometimes you don't want the currency risk. Our view is that if you are able to provide 50% currency exposure, you kind of get best of both worlds. You don't have as much volatility from the currency because you're cutting it in half, but you do have the benefits when foreign currencies start to strengthen a little bit again. So most people, when they're looking at ETFs, they think passive, especially ones that are looking at just market cap weighting as a simple exposure to developed companies overseas. For us, we feel that a 50% exposure to currencies is a way to stay passive and keep that passive view on international investing.
Dan, it's been a pleasure having you on the show. Thanks so much for your time.
Thank you, Sumit. It's a pleasure being here.